How's everyone doing? Welcome back to another episode of the Banker Next Door. I welcome everyone to Report Week, one of the favorite weeks of things that I do. I basically get a collection of all different types of banking reports, things coming from all over the place, and I try to just put them all together, and I like to do it in a weekly fashion where I just cover a number of reports over the course of a week. So our first one today is coming from the San Francisco Federal Reserve. They just did a working paper on tariffs. And what they found was, I don't want to say it was shocking, and I don't want to say that, I'm always right, but every once in a while, it's nice to have your, beliefs reinforced. Okay. So, and before we get into this paper, I'm just going to tell you in a nutshell. Okay. So, what they found was that basically the tariffs ultimately are deflationary, meaning they reduce inflation. It's a deflationary cause and effect. So they found two things from this paper. Number one is that inflation decreases with tariffs, but number two, unemployment increases. Now, obviously, we don't like the unemployment aspect of this, but what tariffs ultimately do is they slow down the economic activity and thus slow down the inflation. And this is why I was explaining to people at the beginning of this year when everyone was freaking out and losing their mind about tariffs, going, "Oh my gosh, the tariffs!" I said no. This is going to be fine. The tariffs are going to help us in the long run. The tariffs are going to massively help us. In the short term, we may feel a little pain, and I believe we are actually feeling a little bit of that pain right now in terms of what's going on in the labor market. The kind of softness, weakening of the labor market. Some of that has to do with tariffs, no doubt. But it will ultimately prove to be a benefit if the manufacturing that the government is looking for comes back. This will prove over time to be an enormous benefit. If the income that we get from tariffs comes in over time, that will be an amazing benefit to the finances of the country. Industries will be rebuilt. Industries will be protected by said tariffs. So there is a lot of positive benefit to come down the road from these tariffs. Our trade agreements with many countries around the world will be much better for us. I have often said that this notion of free trade to me is kind of a joke. It hasn't really been free trade. It's been, the U.S. getting, completely taken advantage of while the other country just tariffs the crap out of us, and somehow politicians in this country got the idea that like, oh, that's, free trade. Free trade is the U.S. getting completely, taken behind the woodshed. So I've never understood that thinking. I've never understood that way of philosophy about, we all want free trade. And in my mind, free trade is I don't tariff you, you don't tariff me. Or if I have 10% tariff, if you have 10% tariffs on me, I'm going to put 10% tariffs on you. Okay. When you have a completely even playing field, that is free trade. Then that gets you to the concept of free trade. Free trade does not work when the U.S. charges you nothing and you hit us with 50% tariffs or 245% tariffs on a good. Like that doesn't work out. But that being said, let's jump into this report here for a second. So this is coming from the Federal Reserve of San Francisco. So what is a tariff shock? Insights from 150 years of tariff policy. Now let's go down here and let's look at the abstract for a second. So in this paper, we exploit 150 years of tariff policy in the U.S. and abroad to estimate the short-run effects of tariff shocks on macro aggregates. A careful review of the major changes in U.S. tariff policy since 1870 shows no systematic relations between the state of the cycle and the direction of the tariff changes, as partisan differences on the effects and desirability of tariffs led to opposite policy responses to similar economic conditions. Exploiting this quasi-random nature of tariffs variations, we find that a tariff hike raises unemployment, lowers economic activity, and lowers inflation. Using only tariff changes driven by long-run considerations, a traditional narrative identification gives similar results. We also obtain similar results if we restrict the sample to the modern post-World War II period, or if we use independent variations from other countries, France and the UK. These findings point towards tariff shocks acting through an aggregate demand channel. Now, we're going to go now. I'm not going to get into all the narrative here with the introduction and historical perspective. Is kind of interesting looking at some of these figures here as far as historical tariff rates across country. You have tariff rates. You could see that those tariff rates have really come down in the United States. You could see UK tariffs have really plunged after World War II and stayed down. France tariffs, again, came down after World War II and have stayed relatively low. And then you get into a narrative count of UF tariffs since 1870. So here is a very interesting chart. They do have some good charts in this report. So average tariff rate for the United States. Again, you can see kind of World War II. You see us really plunging down. Obviously, tariffs were very high in the 1800s and into the early 1900s, because that's how we funded our economy, was through tariffs. You'll notice that it wasn't until 1913 that the Federal Reserve was created and the income tax was introduced. Part of the thinking there was that, we will just tax our people in income tax, and then we can then lower tariffs on other countries, and then thus creating more of a quote unquote free trade environment. That was how the thinking went. But you could see that we mainly paid for our economy, and we protected industry in our economy through tariffs. That's the thing that a lot of people leave out of the conversation. It's not just about putting the tariff in place just to put the tariff in place. It's about putting the tariff in place to protect industries. When you always hear, China can make things cheaper than the US. Well, why do you think they could do that? Part of the reason they could do that, they have a labor force that you could pay cheaper wages to, but they do it because we don't tariff them. We don't put a tariff in place to protect that industry. That's the problem. Like, if you put a tariff in place, the tariff is the great equalizer. Okay, like, in other words, the US guy costs $50 an hour, right? Whereas we could go over here to China and we could pay somebody $10 an hour, okay, or maybe even less than that. But if you put the tariff in place, now all of a sudden, they may only pay that person in China $10 an hour, but then they got to pay a 40% tariff, which now makes it cost, basically it increases that labor cost to say $60 an hour. You're paying the US guy $50. That protects the US guy's job. That makes it more expensive then to go build the product in China when you can just build it cheaper here in the US. That's the whole point of using the tariffs. But anyway, but I digress. So then we see here after, kind of World War I, during World War I, actually, and after, you really see the tariffs come down. But then starting after 1920, you really see those tariffs really ratchet back up almost to a high of 60% in kind of the mid 1930s, when the Great Depression's rolling on. But then it comes down, bounces around a little bit. Then you get World War II, and then really after World War II, you really see the tariff really come down. 1980, it really gets down here, and then obviously with President Trump, it has popped back up here to about 15% overall. So again, just really interesting to look at this stuff, to study it, to really understand what's going on here. But let's keep going down here. So narrative accounts. And then it goes through some very interesting stuff in here. We get the, what do we get? The stop and go tariff changes of 1890, 1894, and 1897. The 1909 Payne-Aldrich Tariff Act of 1913, Underwood Tariff Act, the Emergency Tariff of 1921, and the Fordney-McCumber Tariff of 1922, the Smoot-Hawley Tariff Increase of 1930, the Reciprocal Tariff Trade Agreement, RTTA Act of 1934, GATT negotiation rounds, the temporary tariff surcharges of Nixon in 71 and Ford in 75, Trump tariff increases of 2018. And then we get this nice chart where it says, narratively identified tariff shocks in the United States, 1890 to 2010. You can see here in 1872, we had the Tariff Act of 1872, which was a cut move toward freer trade, reversing high Civil War tariffs. 1890, McKinley Tariff Act was a hike, protecting infant industries. So again, like I said, protecting industry. 1909, the Payne-Aldrich Tariff Act to cut ideological split within the Republican Party. 1922, the Fordney-McCumber Tariff Act, which was a hike, ideological return to protectionism. 1947, Geneva Round, which was a cut, free trade preference, and promoting post-war stability. 1967, the Kennedy Round was a cut, strengthened transatlantic economic integration. 1979, Tokyo Round, which was a cut, free trade preference. 1994, Uruguay Round, the cut, free trade preference. And then 2018, Trump tariffs, which were a hike, national security and strategic. So, and then it goes into a narrative proxy for tariff shocks on the quasi-randomness of U.S. tariff shocks. Estimated results, a first look at the data, and then here we go. So here's the interesting thing again, like I said at the beginning. So this is tariff changes and the U.S. economy. So again, what they found is that inflation decreased. You see the black line here going across. So inflation decreased, unemployment increased. So we could see that here from the two main charts. Their main findings here on the results. And I'm not going to get it because I want to get down to the conclusion here. Tariff shocks. Evidence from France and the UK, like I said here, France, UK, and then conclusion. Okay, so let's look at the conclusion here for a second. So in this paper, we exploit 150 years of tariff policy in the U.S. and abroad to estimate the short-run effects of tariff shocks on macro aggregates. A careful review of the major changes in U.S. tariff policy since 1870 shows no systematic relation between the state of the cycle and the direction of the tariff changes, as partisan differences on the effects and desirabilities of tariffs led to opposite policy responses to similar economic conditions. Exploiting this quasi-random nature of tariff variations, we find that a tariff hike raises unemployment while at the same time lowering economic activity and lowers CPI inflation. Using only tariff changes driven by long-run considerations, a traditional narrative identification gives similar results. We also obtain similar results if we restrict the sample to the modern post-World War II period, or if we use independent variations from other countries, France and the UK. The inflation response goes against the predictions of standard models, whereby CPI inflation would go up in response to higher tariffs. Thank you very much. We provide suggestive evidence that an aggregate demand channel can be at play, but an important avenue for future research is to understand the theoretical reasons for these surprising yet robust findings, which are central to the appropriate monetary response to tariff shocks. So, and I think, yep, that is the end of it. But I want to read that last sentence for a second. The inflation response goes against the predictions of standard models whereby CPI inflation would go up in response to higher tariffs. Hello, Federal Reserve. Hello, economists out there in America. You were wrong. Gosh, that feels so good to say. You were wrong. Okay, here's the evidence right here coming right from your beloved Federal Reserve, right from the San Francisco Federal Reserve. Here's their study, okay, that tariffs do not lead to higher inflation. I've said this a million times. The only thing that leads to higher inflation, one thing and one thing only leads to higher inflation: government spending. Out of control government spending is what leads to inflation. Okay, we need to, and this is why I said we need to cut the spending. We need to get the national deficit. We need to get this back to a balanced budget. We need to start paying down the national debt. We need to reverse this trend and get the debt down. And this can all be done. It can all happen. There just has to be a will. There has to be a will in Congress to make it happen. Congress has to wait for it, actually do their job. And then this can happen. But again, like I've always said, to kind of wrap up with this report, I think this report was fantastic because there's the evidence. There's the proof that tariffs are not going to be this giant boogeyman that is going to bring this massive inflation and wreck the economy. Now, what we do have to be concerned with is that tariffs could lead to higher unemployment. As the economic activity comes down, as inflation comes down, we could lead to higher unemployment. Thus, the labor market should be our primary concern right now. Thus, the Federal Reserve's own projections show inflation coming down throughout 2026 and throughout 2027, as per their own projections. So the labor market needs to be the primary concern right now, which means that the Federal Reserve should be what? Reducing interest rates. They should stop reducing their balance sheet. They need to stop doing that. They need to get money, liquidity back into the repo market, and they need to reduce rates to help the labor market. That's what they need to be doing right now, which Jeremy Powell is not. So anyway, okay. That's off my soapbox there for the moment. So, okay. Great report here to start the week. I've got some other stuff coming in. We've got, what else do I got here? I've got review of Bank Directors 2026 Bank M&A survey. I got review of CSBS. Is basically did some research showing the community banks pay more for compliance. Really interesting. 10-year research report there on that. Review of 2024 CRA lending data from the OCC. And then finally, we're going to end the week with a review of the October 2025 Federal Reserve Senior Loan Officer Opinion Survey, also known as the SLOOS. So those are the 5 reports I'm going to be covering this week. So I will wrap up by saying I thank you so much for listening. I hope everybody will please like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. I hope you have a great day out there, and I'll see you again real soon.